Thank you all for joining us today, and thanks to my fellow panelists for taking the time out of their busy schedules to devote some time to this, what's hopefully going to be a stimulating and thought-provoking discussion. We're going to be discussing choppy waters, liquidity in FX and beyond in 2022, and thanks to you, the audience, for participating too. I heard it might be a little bit edgy, as some of you may have come back from the pub. I think we're going to be okay. So I'm firstly, given these people have given up some of their time, going to let them introduce themselves individually and talk a little bit about what they do at their firms. Thank you.
Thanks, Chris. I'm Artur Delijergijevs. Don't try to remember my surname. It's quite long and winged. I work for CMC Markets Connect. I'm a quant trading manager. I've been with the company for about 11 years.
Hi, I'm Andy Biggs. I'm the Group Head of Risk and Liquidity for the Finalto Group. And I generally run the liquidity and product section along with the risk section of the group.
Hi, everybody. My name is Ozgun Unal. I'm the head of EFX sales for UK for the UBS Investment Bank. I've been at UBS for 11 years, and we provide liquidity to institutional clients in FX and many other products as well. And yeah.
Hi, I'm Johnny Brewer. I'm one of the founding partners of IS Prime. We are a primer prime in the offering liquidity in foreign exchange and commodities.
And I'm Jeremy Smart. I run global distribution for XTX Markets. We're a non-bank market maker, making markets across equities, futures, commodities, and foreign exchange, and a little bit of crypto.
Thank you all. I can't believe any of you are salespeople because you all talked less than 30 seconds. So thank you for doing that. Okay, so let's start. Let's set the scene on FX. I spend a long time in FX, but actually there's a lot of other distracting instruments and assets out there that are moving an awful lot. So aside from, say, the DXY that's recently broken out of its trend line, FX has been kind of stable and it's also kind of liquid. But obviously you've got divergent inflation profiles and different central bank policy actions. How do you see this impacting currency markets in 2022? Can one of you set the scene?
I'm happy to go first. I'm not sure, if it's been stable or liquid, maybe less volatile versus 2020, but we've still seen, I think, some liquidity squeezes. Maybe not in spot market, but definitely on the yield curve. We've seen Kiwi rates squeezing. We've seen Turkish lira in the summer, where short-term funding was really, really hard to find, and a little mini flash crash in even gold, squeezing liquidity in the market. But I think, as obviously central banks' QE programs are scaling back, I think we will see some volatility in FX in 2022. If you look at, I don't know, do you want me to talk a little bit macro, just in terms of currency pairs?
I think it's great to set the scene.
Sure. So I think in 2021, Euro couldn't have been unluckier. I think the growth expectations were quite, expected growth prospections were really good, but with longer than expected, virus-related lockdowns, and obviously in June, Fed hawkish pivot, move on higher inflation, and then when the world started reopening, there were bottlenecks in supply. So that created concerns for, I think, global stagflation and a safe haven bid for dollar. But I don't think that's going to continue. I think Europe generally has a better growth prospect versus US in 2022, in my opinion. As UBS, we are dollar bearish in 2022.
You're European.
But I think the Q3 GDP performance is pointing that stronger European growth versus US. And I think ECB policy could be more impactful than, again, Fed's. And with the world obviously reopening and that supply bottleneck disappearing, I think that safe haven bid for dollar will disappear. Swiss franc again, I think safe to say that we think it's going to be benefiting from this dollar weakness. Sterling, for example, I think it's set for growth. Definitely there is that element, unless obviously we have this Northern Ireland protocol issues. If obviously there's some derailment there, then that could impact the EU, UK trade talks. I think Bank of England, again, tightening policy will continue. I think 100 basis points is already priced in, but I don't think that's restrictive enough. It could be more. So on and on, we can continue. But I think mainly, I also wanted to mention about EM. I think EM markets have been quite volatile versus G10 this year. I personally think that there's going to be more flows going into EM into 2022. I think this market still offer a better spread retention versus G10. I know that most banks have invested heavily in their technology for offering ENDFs and EM currency pairs electronically. This should actually help by more market participants pricing and consuming EM liquidity. I think this should refuel the EM markets and see a market cap increase in those markets. And that's my macro view.
That's great. I think that's actually an interesting segue into question 2, because you've talked about some areas that will
Chris,
have capital.
one thing I was just going to say just as an observation that just occurred to me was that I think a lot of the people, this might have been the case with a lot of people in the room here, is that we over the last 6 months have seen we've seen more flow in gold than we've seen in Eurodollar. So actually, it's clear to me that the retail market is hungry for volatility, because that's got to be the reason why gold has taken over from Eurodollar as the most traded product. So I certainly hope that more volatility will come into the market over the course of the next 12 months. I think that's probably one thing that everyone in the room will agree on. But yeah, I just think it's an interesting observation that for me is a very clear indication that the retail market has been looking for more volatility, because they've been trading much more in a more volatile product.
Thanks, Johnny. I think we'll expand our mandate on the fly from FX to also precious metals, because I think you've probably all got a view on liquidity in that market too, and I'm sure the audience. Well, I have a personal interest, so I'll just keep asking the questions. So how should FX and precious metal participants be analysing and considering liquidity, and how is technology adapting to a system in this task? And I want you to try and also include your thoughts around prime liquidity.
I guess we're in the information age now, so it's very, very, very important, I think, to store as much data as you possibly can. Storage is cheap. The ability to analyze it is slightly more expensive, and then the ability to analyze it quickly is even more expensive. But I think as there's been panels earlier on that have talked about the democratization of finance and the democratization of the analytics and the analytics platforms that exclusively sat at bank or non-bank market makers. You now have prime of primes who recreated them, and then you have other third-party vendors that can do a pretty good job now of recreating some of the institutional analytics. I think without that visibility into your flow, into what's happening, it can be very, very difficult to manage liquidity, not just from a client point of view and figure out where clients fit in custom bespoke liquidity pools, but also managing and controlling the liquidity providers. It's important from a prime of primes point of view to manage both sides and ensure that the liquidity providers are playing as fair as the clients are. So to me, analytics and the ability to process large amounts of data, have the people to analyze it, and then the people to communicate not only to clients but also to liquidity providers is essential. And to add, I guess my views on prime of prime liquidity are going to be slightly biased. I think the ability, prime of prime covers a very large range of companies. But if I focus it on companies who have prime brokers themselves, who deal with tier 1 market makers, be they bank or non-bank, and then create custom bespoke liquidity pools out to their clients, the offering generally from prime of primes is quite incredible, in that the price that prime of primes achieve are significantly better than most people, I think, or most clients could do themselves if they were to go and get a PB. Without that data analytics, without the team behind it, curating the liquidity, you're not going to get, I don't think, as good a price. You can get quite close, but it's unlikely you'll get as close with then the margin and credit terms that a prime of prime would provide, and all at the cost of pretty much a prime broker. So I think the prime of prime space has become extremely competitive, and the pricing they can pump out in FX and in precious metals is extremely good.
Thank you.
From the perspective of a market maker, making prices into prime of primes and into retail who have their own primes, for example, and other clients who have their own primes, our pricing adjusts absolutely exactly to the data that we see. So the quality of the flow impacts the price absolutely, the price and the depth of liquidity that we're able to show. We don't differentiate because I happen to like Andy more than I like Johnny, for example.
Is that true?
I think most people do.
He paid me to say that earlier, so
I do have a much shinier head, though.
It's not a clear mark. It's not a clean market. But we absolutely just analyse the data as it comes through, and that feeds on a fully automated basis into the loop of our liquidity, our pricing. We widen spreads on an automated basis, tighten spreads on an automated basis, determined entirely by the mark out of the trades that we see. So the curation of liquidity by prime of primes is absolutely critical to the end liquidity that their clients see. And it's a fully automated process now. I'm sure it probably is at UBS as well. That's pretty standard now for the industry, or certainly becoming more and more standard. And of course, we can make changes according to, if Johnny calls me up and says, actually, I removed this client, or I added that client, or I did whatever, and we can change it and sort of reset the process. But in general, it's a fully automated process. So the job that these guys do impacts absolutely the liquidity we provide to them, and therefore the end liquidity to their clients. You're just very fortunate to have guys who do it very well here, because there are quite a few in the market who don't do it anywhere near as well as these guys do. And I'm not just saying that because they're clients. I would genuinely believe that.
Kind words.
Yeah, maybe
That's
I could
20
just
quid, by the way,
to follow on from what Jeremy said. I mean, I completely agree with you. I think on our side we've automated a lot of things over the years, and we had analytics for obviously spot effects for a long time now. But what I see the evolvement. So, for example, for me as a salesperson internally, we have quite a lot of analytics tools built over the last 2 years, not just for spot but for STIR and for FX derivatives, because we're active in these markets as well. Automated sales alerts, bots. It's quite actually detailed based on quite a lot of data that we see from our clients trading. It's very similar to what you said, Jeremy. And everything is I'm a believer of full automation, and I want to automate everything as much as possible, so that I have more time to spend with more strategizing with our clients, how we can improve the relationship, right? And for those maybe less sophisticated clients who don't have the IT budget or the infrastructure to develop these tools. What we've seen, I think, in the last couple of years, some third-party external, TCA and analytics providers coming into the market and bridging that gap. And I think every market participant in this business should invest in those analytics in one shape or form if they want to manage this business based on data, so that they can measure the market impact, they can look at the decay charts, not just for their clients, but also for to manage the relationships with their liquidity providers. So all of a sudden, I think emotional conversations about my spread, my reject ratio becomes a lot more powerful. You lose that, and you base everything on facts and data. And I think that's quite important, and we need that, I think, iteration across all market participants to move to the next level.
I was going to echo exactly what Jeremy and Ozgun said, basically. The step towards the direction of understanding the liquidity you get is to understand the type of flow you're sending out of your doors. And that comes with basically ability to analyze your data, understand the type of flow you inherit from your clients and what your exist looks like. But then also maintaining the conversation with your LPs. Although obviously the decision in terms of the spreads and liquidity you get is automated. It's not because we're friends, we're pals. But having that open dialogue with your LP is very important, because if you just simply sit in isolated bunker and trying to analyze the data, fine, you're going to get somewhere, you understand what you're getting in terms of liquidity, but you might not be able to understand how your LP views that flow you're sending out of the doors. So to align that understanding between the liquidity taker and liquidity provider in terms of value of a flow going out of the doors, the dialogue is very important, I think.
I think there's a prevailing, fallacy is probably too strong a word, but a prevailing misconception in particularly the retail market, that all liquidity is the same. So if IS Prime have UBS as an LP and Finalto have UBS as an LP, and name any other client that has, let's say, UBS as an LP, it doesn't mean that the price that you're going to see from each of those individual primes is necessarily or in any way the same. So because and it's certainly the case that if you were to get a prime broker and then go direct to let's say tier 1 LPs, to use a generic term, that the pricing that you would get in turn would be the same. So I think there's this misconception that the prime community is effectively just a middleman that is adding an additional layer of cost on top of, let's say, tier 1 aggregated liquidity. It's there's rather more to it than that in most cases, and I think some of the primes have somewhat shot themselves in the foot in that respect, because I think some of the primes are advertising themselves as pure liquidity pass-throughs. I think sort of trying to see themselves as kind of secondary primes, whereas certainly in our case, we see ourselves as a business that is, our primary product is liquidity. Our primary product is the price that we send out to clients and their ability to execute on that price. Clearing is very much a secondary, or the prime side of it is very much a secondary thing, and I think that's certainly the overall impression of the prime industry at the retail market level. I think is often somewhat misunderstood for those reasons.
Thank you. How has the customers' sophistication and expectations changed in the last, say, few years, and how do you think that will transform in the coming 2 years?
With our clients, I mean, the sophistication is I'm very impressed, I have to say, with some of our clients that we manage the liquidity relationships, but with some of them, it's not. Like Jeremy was saying, not all clients are at the same sophistication level. There's definitely a move towards a lot of automation, a lot of tag management within this client base, and I think it's the know-how as well. They know their clients. So if you know your client, then you can give them the right liquidity pool to cater for their trading style, right? So I think that's why prime of primes, I think, play quite an important role in the market, because we can't face every client anyway, right? As a tier 1 liquidity provider, I can't have every client on earth, because I have credit restrictions, I have local regulation restrictions, and we don't cover any retail clients. We can only face regulated institutional clients. So I think they're like an extension of the distribution, but at a I think much more analytical way, with the tools that they build themselves, and aggregating that liquidity correctly, I think is quite important. So the sophistication is there when you see that they manage their clients and liquidity, and you don't need to you don't need to intervene as much when you're looking after the relationship. That's when you know that things are actually done on their side, so you don't need to intervene.
For me, where we sit, the increasing sophistication of our clients allows for much better conversations. It becomes a lot easier to have a data-driven conversation with a client, so you're both on the same page, you both understand what's good, what's bad. Bad isn't necessarily bad, it just needs to be repriced. And once there's a common understanding, it means it becomes a much better partnership than emotional phone calls.
As you said, take the emotions out of it.
I was just going to say, I mean, globally it feels very different. So in Europe, I'd say the market is now relatively sophisticated. In the US, similarly. In Asia, it's 2, 3, 4 years behind. right? And I get this every time. I mean, every time I go to Asia, I think, wild, wild east. It's like some of the stuff that's going on in Asia is exactly the way the market was in Europe 3-4 years ago. And to characterize what John, right? And to just sort of plagiarize what Johnny said earlier, this idea that all liquidity is the same, or that more liquidity is better, and just if I keep adding people, I mean, you only have to look at, some of the public reports from Japanese retail brokers, when they're listing down to, liquidity provider number 37, and you're sitting there thinking, I mean, there just aren't 37, I mean, there aren't 10 liquidity providers in the market, let alone 37. Maybe that's a bit controversial. Maybe there's some other people that would claim to be outside the top 10, but liquidity providers. But, in all seriousness, it's some number around that, right, that are real liquidity providers to the market. And, you go to Asia and the over-aggregation and the treatment of all liquidity is the same, and this just attitude, pervasive attitude of I'm just going to keep adding people. And it's not always in just retail. I mean, I see it in hedge funds. I've got, a hedge fund client in Asia that I'm sure Ozgun's firm prices also. And they've got 24 liquidity providers. And I'm like, how have you got 20? And I guarantee you that of that 24, 14 are taking liquidity from me. Right? So, this sort of recycling of liquidity still happens in Asia. It happens a lot less here. And I would say also, and why am I being so nice about prime and primes? But anyway, they do a fantastic job, actually, in driving the conversation forward, because the conversations we have with the likes of Johnny and Artur and Andy are then the conversations that they have with their clients, right? So that knowledge transfer becomes a chain of events going through the market. And, what we need is you guys to all be bigger in Asia.
I think a lot of the LPs have also been doing, we're trying, by the way, but I think a lot of the LPs have been doing a much better job, actually, of policing liquidity and where their liquidity goes. So it was often a frustration of ours that we were trying to manage liquidity in the right way, and some of our, let's say, peers were over-aggregating, doing exactly all of the, or committing all of the crimes that Jeremy just mentioned, but because they weren't necessarily policed by their liquidity providers, it wasn't always the case that necessarily the cleanest liquidity pool actually necessarily won out. But I think certainly in the last 18 months, 2 years, I mean, I imagine everybody who's a client of one of these two have probably had a slap on the wrist for skew leakage, for example, which never used to be quite as much of a focus on behalf of the LPs that it certainly is now. So one challenge that's created for us, which we always did previously, but there's an even bigger focus on it, is actually making sure that we're controlling where our clients are putting the price feed, because what our clients do with the price feed that we're providing to them can have knock-on effects, let's say, upstream as well. So, but yeah, it's definitely been a trend that I think clients are getting more sophisticated. That's just a natural progress over time. But I think also liquidity providers have become much more focused on actually policing where their liquidity is going and what their clients are doing with it.
Yeah, I mean, there is a fundamental dichotomy in some part of the market here, which is that the end, particularly in retail, the end retail clients the end retail brokers, I should say, not the clients, but the brokers are essentially paid on volume, right? They're traditional brokers, right? So they're paid by volume. So, a client comes in with an API and says, I trade on API, I do 2 yards a day, 3 yards a day, and eyes go wide and the tills start ringing and so on and so forth. And if I knew that conversation was happening, the hairs on my arm would be standing up, the hairs on the back of my neck would be standing out, and I'd be thinking skew leakage, right, immediately. And I'd be thinking, I do not want to price that client with any alpha, right, or any edge, or any part of my position, or, the skew on my mid that I created through research, right? I spend millions and millions of dollars a year on research just to give it away on an API to some, iffy client in, I don't know.
Somewhere.
Wherever, yeah, wherever. Yeah, you know, I can't afford to do that because that leakage comes all the way back and destroys all of my market making activities on primary markets, on secondary markets, and with large swathes of my institutional clients, right? And it's extremely damaging in terms of the monetary impact. So that's where the role, again, between ourselves and the primes to educate that end client base around that is so important because there is that fundamental dichotomy. I totally appreciate it. If I was in the retail broker, I'd be doing exactly the same thing. Client walks in through my door, 3 yards of business a day, happy days. But in the end, you have to ask yourself, is that business really sustainable, or can I really, you know, can I blow up my pricing for all my other clients if I get this wrong? Right.
Yeah, just to add on education piece, we've embarked on that journey with some of our institutional clients, whereby some of them are susceptible to education and they're trying to understand and trying to learn and improve processes on their side. Some other brokers, who's generally mentioned on a retail side, simply don't care. They wouldn't care about the market leakage, you know, information leakage, market impact after they trade. All they do is purely trade or are perceived purely on how much volume they do. They don't really care about the post-trade market impact or any other things. And one more thing to add in terms of going back to the question around liquidity, I think diversity as well. It's when you're sculpturing liquidity pool, I guess prime of primes would kind of be quite good at that, is sourcing the liquidity from diverse liquidity providers. So it's finding the diverse providers, because otherwise what you end up having is a chance of increased recycling liquidity, but as well as, let's say, markets are kicking off, like we've seen in COVID times, the first lockdown with gold, and suddenly there's market dislocation, and if you've got a couple of providers who are using the same market-making models to price gold, then you might not get a competitive offering throughout that period. So diversity would ensure that you've got a good enough liquidity and tight, consistent, aggregated spreads.
So it sounds, volume-driven salespeople aside, and of course I was one for many years, that the market's become much more data-driven, much more fact-based, and much more grown up as participants, and then you work through things together from a factual perspective.
Yeah, but it's also understanding what the downstream impact is. I mean, if I go through that logical example, so I price something, you know, to one of these guys, they price onto the retail broker and they price onto a client, and there's significant skew leakage, and what comes back to me is like, okay, that stream is now leaking because we watermark those prices, so we find out that the stream leaks. The first thing that we will do is widen the prices, take out the alpha, and make the stream less valuable, right? And then that impacts all of the clients that, you know, either Johnny has or Andy has or Artur has, right? And fundamentally, that downstream broker, in the end, is destroying their own market. So the sustainability of that 2.5, 3, what did I say, 3 yards a day, whatever, the sustainability of that is ultimately very questionable, right? And in the end, you end up with a less competitive, as the downstream retail broker, you end up with a less competitive price as a result of who you select to price at the end. And then you run the risk of being outcompeted by other people who curate their business better.
Thanks,
But that's basically a problem that's existed since brokerage has existed, right? It's you don't always necessarily want to trade with a client that wants to trade with you. I mean, Biggsy, you'll remember back in our Queen Anne Street days in Raj and my office, we had "Not all business is good business" written in red in red writing, big red writing on our whiteboard. And it's very much the case. It's it's one of the hardest things to do as a broker, to turn down the 2 yard a day client that is ultimately going to take away more from your liquidity pool and from your business than they're going to contribute. It's also nice when occasionally you find one that actually is a genuine 2 yard a day client that actually won't do that, but they're as rare as hen's teeth. So, but it is very much the case for retail brokers as well, that choosing which clients you want to do business with and which clients you maybe want to be a little more careful with is the game, and actually you can't really do that unless you actually get to a certain critical mass and a certain scale, and that's why actually a lot of the new primes that are coming on the market or the subprimes, as I think we rather condescendingly called it in a press release, are going to struggle to manage that exact problem, because it's even harder to say no to business or to price business defensively if you're starting out and if you haven't got to a stage of critical mass. So it's a problem for brokers, big or small, but particularly difficult for guys who are kind of finding their feet, so to speak.
Thank you. I used to have "hope is not a strategy" written on the board in my office back in the day. I want to try and change tack a bit, if that's okay. I guess we heard a lot about crypto today, and if Bitcoin's a new gold, albeit it's 12% less gold than it was 2 days ago, and Ethereum is, the utility, and we're looking at DeFi, etc. How should our audience be thinking about the impact on FX markets of crypto and blockchain technologies, particularly in a world of Bitcoins, CBDCs?
Perfect, thank you. So crypto, I'm going to actually divide it by crypto and then maybe blockchain and CBDCs, because I think they're two different things. Connected to FX markets, yes. Impacting FX markets, no, or maybe not yet, I can say. And let me tell you, explain what I mean by that. I think fiat currencies, dollar, euro, they're issued by central banks. You can exchange them against each other. You can actually buy household items like bread or milk. Whereas crypto is not a currency, it's an asset. It's just like any other stock. You have to actually purchase it by, giving US dollars away and buying the asset class, right? So I think from that perspective, we should, I think that this is the connection, right? You actually need to use the fiat currency, the FX market, to purchase the asset. And if we look at the crypto asset market cap, I think it's reached 3 trillion, I think, including Bitcoin.
Until about 2 days ago.
Right, yeah, exactly, recently. So, this is, I think, what's similar to the market cap of Apple stock. So, right, but FX, we trade 4 trillion every day, right? So I think just to give you guys the kind of the view of where crypto is versus FX market, and I think it's definitely coming out of age as an asset class. I think we're going to see more and more, and I think it's going to grow. I just don't see that it's going to be affecting or impacting FX markets just yet. I think it needs to really grow. There needs to be some institutional involvement in there, etc. Right? I think we're not there yet. Sorry.
I was just going to say, before you go on to blockchain, because I agree with you, it's a slightly separate subject. I kind of disagree, right? In that, I think imagine, I agree with you that it's an asset and a store of value and a commodity and all of that kind of stuff. I hear central bankers say that, crypto is an unbacked asset, and fiat currency is what? Right? Last time I checked, we abandoned the gold standard. You know this better than I do, Chris, because you were alive
I'm older
then,
than you.
Yeah. So, but we came off the gold standard a long, long time ago, right? So, fiat currency is unbacked. It's only backed by the belief system that we believe in our government. And crypto is a belief system, right? And cryptocurrencies are a belief system. There's no reason, given the tokenization that exists with crypto and the technology which underlies it, why it can't be used as a mechanism of payment. Absolutely no reason. And if you were a corporate with 35 offices around the world, wouldn't you rather run one Ethereum account, right? Or 35 different FX accounts where you've got FX risk, exposure across all these things, et cetera, et cetera. Got to pay people in different currencies, settle invoices in different currencies. There's a whole massive infrastructure around that. Not to mention the fact that as a world, we still send gazillions of dollars all around the world every day for no apparent reason that I can figure out. And you sit there thinking, well, actually, this could completely replace the monetary system of the world, and there's absolutely no reason why. Now, could governments stop it tomorrow? They probably could, and they could probably find ways to do that, but I'm not sure that would necessarily, in the end, be really in their interests to do that. So I hear what you're saying, and I don't know, by the way, what the timelines around this look like, and that's probably the most difficult thing to really understand, and it probably will happen when I'm long retired, right? But which might hopefully be quite soon. But you know, it feels like it feels like it's definitely doable, or it definitely could happen that cryptocurrencies become, or some cryptocurrencies become an accepted standard of payment, accepted standard of value, you know, that I could send to Johnny on my phone, he could send back to me. There's no reason why we couldn't do that, you know. I don't know why I'd be sending you money, but, you know.
But, so I guess...
But this is exactly what I was going to actually come to blockchain and CBDCs for.
You know, I think you're taking a snapshot of today and Jeremy's talking about tomorrow.
Yeah. So I was just talking about right now, and I do believe that, yes, that is the way that it's going to go forward. And that's why I think the blockchain and CBDCs are, I think, a step forward to achieving, to getting there.
They definitely are. I guess my point is that if the market does move in the direction that I've sort of indicated it could move in, then you can see a world where FX is a much less significant instrument, right, and a much less significantly traded asset. Not because FX doesn't still exist, because there won't still be fiat currencies in each currency, because I think there will be, because I think, you know, monetary policy is fundamentally linked to sovereignty, right? So there's, and you know, wasn't that ever better shown during various Euro crises and Brexit and yada yada, right? So I still think there will be central bank, you know, digital currencies, et cetera, but I personally would quite happily hold some pounds and some Ethereum and some something else. And I would quite happily on my phone have an app where I could pay for stuff from any one of those things, wherever I was in the world, quite happily.
But if XTX were going to pay your substantial salary in Ether or Bitcoin, would you accept that in place of fiat right now?
And how would you pay your rent? Your,
place of a fiat or fiat currency.
Fiat currency.
Sorry, oh yeah. No, I never understood why they named it after crap cars. But anyway, I guess the answer to that is actually I probably would if there was enough diversity in it. Like if it wasn't all in Ethereum, right, then I probably would accept some part of it. But probably not yet is the answer. But I can see a world where I can get there. Yeah, absolutely.
But at that point, or before that point, you fundamentally undermine the fabric of that implicit guarantee between the taxpayer and the government, and then it does have an impact. Or, you know, when do you think that happens? I was listening to a podcast the other day where they said the metaverse, it is not a thing or a place. It's the point where your life is more digital than it is physical. So there's a point where the world pivots. At what point do you think the world pivots and liquidity in effect disappears from FX? How far away from that? Do we care about that today?
I don't think you have to care about it today, no. And I think probably over the next 5 years, probably not that big a deal. Over the 10 to 20 year time frame, I think it could be absolutely huge. And I mean, it's very hard. If you think now, I mean, you know, again, Chris, we're old enough to remember the world before the internet, right? But now it's inconceivable to even think of the world pre the internet, right? And that's only 20 years ago, just over 20 years ago, really, right? That the internet became a genuinely sort of useful public good in any way. And even then, to begin with, most of us thought, oh, this is cool. We can sort of like search for news and information and stuff. Now it's absolutely central to everything we do in our lives. Right? And when it's down in your house, it's like the worst day ever, right?
If you've got kids, yeah, it's a nightmare.
But I think, oh, sorry, go ahead.
So I was just going to say, I think for this group, the more probably pertinent question than when is crypto going to become, let's say, more mainstream than fiat, or you know, however we were sort of characterizing the question, is actually, are we currently at the inflection point where the risk for people in this industry of not taking crypto seriously and not getting into crypto is greater than the risk of investing a lot of money in it and it turning out to be something that was an imaginary thing that was created as a result of a lot of quantitative easing? And I think, obviously, a lot of firms have already crossed that Rubicon. We're probably around about there, which is quite a change. Because I remember I was on a panel actually at this conference about 4 or 5 years ago, and I made some glib comment about it's nice to see all the guys that used to be doing binary options are now doing cryptos, and I think those people that are now doing cryptos are laughing at me rather than the other way around. So, but yeah, I think that for now is the question: is is the risk of missing out greater than the risk of doing it and potentially writing off an investment? And I think most people are at a stage where they think that it definitely is. Or many have already made that decision a few years ago. So,
Thank you.
I think there's two ways to sort of look at the crypto stuff, and it seems to like we're divided in terms of kind of opinions. So obviously, you can look at the crypto as an asset class, and to which you can get an exposure and potentially generate returns from your strategy. Other side of crypto is going back to what Jeremy and Ozgun been discussing is, can crypto become a replacement to your traditional fiat currencies? And I think there's a few things which kind of needs to be addressed and solved before that could happen. One of them is we're increasingly becoming a cashless society already. So, and pandemic has accelerated. So how many people actually carrying cash nowadays? So, as a blockchain technology, replacing cash, a version of e-sterling, for example, but it's totally possible because we're already effectively paying everything through online. I'm receiving a salary into my bank account. There's just numbers on a screen. I'm making a payments online. I'm making a payments through Apple Pay and through transfers. So using a blockchain technology for that is entirely possible. A problem there is the transaction cost on a blockchain currently is too expensive to replace everyday payments. I can't go, even if some companies accepted bitcoins or some coffee shops accepted bitcoins as a payment, I would still incur a $3 charge for the transaction fee. So
that's just a matter of time, though, isn't it? I mean, it's like me buying data on my mobile phone. It's kind of free, right? I mean, it's we're at the point now you can, I don't know, 20 quid a month SIM gets you free data. Free unlimited data, probably cheaper than that actually you can get. It's a matter of progress and time
exactly.
before that changes.
Yeah, go on, sorry.
We stole your...
Yeah, no, I was just, I mean, it all kind of ties in together, right? What I was going to say was like, you need to take step by step. The industry, the FX industry is huge. There's quite a lot of regulation. Before you can jump into crypto or offering crypto liquidity, etc., you need to follow certain steps for the industry to actually have that infrastructure to be able to, accept crypto as an asset and maybe offer it. So, and that's where I think blockchain and the CBDCs come into play, right? I mean, I think it's quite exciting that some of the central banks are looking to, talking about creating their own digital currencies. I mean, we actually are involved in a project called Project Euro. I don't know if anybody knows that, for example. It's on the public domain. Please go read it. It's a project by Bank of International Settlements Innovation Lab, SMB, and Banque de France, and a consortium of banks. And it's looking to basically tackle the cross-border settlements across different products. And I think this is kind of like the basis of maybe settling FX spot in T+0, right? I mean, this is where we need to get to first, I think, as an industry, before we can jump to further developments.
Well, maybe, but I don't see, there's lots and lots of track record of our industry moving into derivative products, which offer liquidity based on the reference price of the asset before, we could be trading physical, but we also might be trading swaps on futures or swaps on the physical or, any kind of derivative products of it. So I don't, it's not 100% clear to me exactly how the market is going to evolve from that perspective. Clearly there are investors who want to buy physical and hold physical, that's for sure, but there are many who just want exposure to the monetary value of the instrument, right? And that could be very different depending on whether it becomes a currency that you actually use to pay for stuff or you don't use to pay for stuff, etc. And also, of course, like again, as I said, sort of an ultimate hedging tool if that's how you wanted to hedge exposures that you had, etc., etc. So one thing that's going to be very interesting is whether crypto is going to follow the FX industry structure or the commodities industry structure, or the swaps industry structure, because they're all quite different, right? At the moment, it feels like it's going the FX route, right? And I think we would probably all agree with that. But it's still not 100% clear. I mean, it's not clear what legal documents govern crypto trading, right? Other than bespoke, made up, agreements, right? Like there's no ISDA definition, there's no standards, around that, et cetera, et cetera. So there still is a long way to go, but there's no doubt it's coming. And I think it has the potential to transform everything about our market. And by the way, I think it also has the potential, to transform the banking market in its entirety. Because, at the point where financial transactions are happening on a blockchain, what exactly do you need a bank for?
Just a balance sheet.
Yeah, exactly, right. But balance sheets exist all over the place, right? I mean, all entities
Correct.
have balance sheets. I thought it was very interesting reading, I don't know if anyone read Cunliffe from the Bank of England, his comments on crypto, but I thought were really interesting. Basically said pretty much, I mean, he's not his job to regulate it, but he basically said, I don't really want this stuff anywhere near banks. Right, so it was kind of interesting, right? Like he was basically saying, I don't want banks giving leverage in it, and I don't want banks exposed to the asset. Which means you can trade it, but you've got to turn it over and basically have no exposure, et cetera, et cetera. And I think there's potentially a lot of industry structure ramifications that come from this.
So
Too lengthy for now.
I think
but
you've linked us nicely to the next point. Is what does that sort of institutional crypto model look like?
I think that really depends on what you want to get out of it. So is it just exposure to the price movement? So it's a CFD on a crypto, and lots of the people in this room and building can offer that at the minute. Or is it for maybe the more institutional players, it's something like an NDF, where I think we're seeing more interest in creation of NDFs across a few coins? Or is it physical? It sounds silly to call cryptocurrencies physical, but is it where you actually hold a physical cryptocurrency? I think that on an institutional basis is a much heavier lift and doesn't have, the ecosystem is growing quite significantly there, but it's quite a heavy lift, it's quite a big setup, and there's lots of security concerns around it. And frankly, without a bit more regulation, it's going to be difficult for large institutions to get compliance and legal sign-off for physical crypto.
I think one of the interesting things about crypto, and we've been doing a little bit of peering into a crystal ball, but one thing that appears on the horizon in my crystal ball is that, specifically related to cryptos, is that I think one of the challenges for retail brokers is certainly working out, actually, yes, liquidity is a massive challenge in cryptos, and exactly how they are going to access risk is one question, but actually how are retail brokers going to run their risk and how are they going to manage their risk in cryptos? I mean, it wouldn't be, I think, a surprise if the next big retail broker default will be as a result of a retail broker running a huge amount of risk on Bitcoin on the day that it goes from 60 grand to 40 grand. It's obviously
Number 27 in the Japanese list, right?
Right. Yeah. So wherever cryptos are going to end up, or wherever the Bitcoin price, let's say, is going to end up, I think it's obviously not going to be just a straight line. So it's going to be a bumpy road, and I think the general risk appetite amongst retail brokers is obviously relatively risk loving, and I don't think many of them have really quite got their head around particularly cryptocurrencies in terms of how they're going to manage that risk.
I would definitely echo Johnny's comments there. I would agree with all of that. Regarding the NDF, I mean, the NDF's an interesting one because there's a lot of talk about NDFs right now, and it's definitely something that people are looking at, etc. But the NDF just references the future. I mean, all the liquidity is in physical, right? The NDF will reference the CME future, which is available 24 hours a day. No, 22 and a bit hours a day, 5 days a week, right? The physical will be trading on the weekend, et cetera, et cetera, et cetera. I mean, and all of the hedge funds that I talk to, they want to trade the physical. They don't want exposure to the NDF, right? The NDF is a poor substitute. Unlike when you're trading, can I say real NDFs? Is there such a thing? But real NDFs, right, where actually that's where the liquidity is, right? In Korean won, the liquidity is in the NDF, not in onshore spot, right, or onshore spot. So, that's going to be interesting to see, I think, how that NDF thing plays out. I think short term it will grow, and it will grow quite quickly probably, but then my gut feel is it'll tail off after a period of time once people get more comfortable with the infrastructure of how to trade and actually either trade and hold physical, right? And there are definitely mechanisms coming to make it much easier, much more secure, and much less risky from a kind of holding, custody, settlement, etc. point of view. But in the meantime, I certainly see a world where you could trade swaps on the physical, and that would be a very reasonable proxy, and people who could trade the physical would trade the physical and make markets and take in it. I could see that. And I could see that list being 100 plus coins quite easily.
I think as a institution who offers derivative on a crypto asset class to our retail clients and institutional clients, we've seen a change in a sort of landscape of a crypto community. 4 years ago, 3-4 years ago, maybe it was difficult to find a sort of more, not necessarily legitimate counterparties to deal with, but more of counterparties in the jurisdictions your compliance team would be happy to deal with. I think currently that's changed. There are custodians who are regulated, who operate in jurisdictions where your compliance is going to, and auditors are going to be happy, and there's plenty of liquidity. So from our perspective, as a sort of market maker in a crypto space, in a derivative space, we do have access to exchanges. We trade physical, we hedge physical, and we store physical coins as our hedges with our custodians. So some of those problems have been solved already and easily accessible by anyone. I think that difference in terms of what you've mentioned, Andy, in terms of people looking to access to the alpha, to the volatility or exposure to the price moves effectively of a product, are potentially looking for more traditional setups to go through the traditional prime brokerage, clearing, and they don't actually want to have anything to do with physical coins being cleared or management of custodians and wallets and that kind of stuff. They purely want to do the swap in a more traditional setup with a PB, and that's it.
Thank you. What a fascinating panel this has been. Thank you. We've covered macroeconomic themes from an FX perspective. We've talked about the changing landscape and the technology that's available and the sophistication and the cooperation of the industry. And we've touched on the intersection between currency markets and crypto markets. And we kind of looked at sort of the last 2 years and the next 20 years all in the space of 50 minutes, which has passed in the blink of an eye. So thank you so much to the panelists for your insight and your intelligence. Thanks for giving time up in your day. Thanks to the audience for listening. We've enjoyed having you along. Hope you enjoyed it too. And enjoy your evening. Thank you.
Cheers. Thank you, Chris.